Have you ever felt that cold dread when the calendar flips to the first of the month
Oh, yeah.
and you realize that the very foundation of your financial stability,
Mhm.
your ability to pay the mortgage, is suddenly in jeopardy?
It's a terrifying
It
feeling.
could be anything, right?
Yeah.
An unexpected medical crisis, a
Yeah.
big shift in your job, or, like the whole world saw in 2020, a massive economic shock that just grinds everything to a halt.
And the ultimate fear in that scenario is always the same.
Foreclosure, loss of your home.
Exactly. That anxiety is, I think, universal and really profound. But what a lot of people don't realize, or maybe just forget in the panic, is that the path from a missed payment to a foreclosure notice isn't. Well, it's not immediate.
There's a stepping between.
There is. Between the borrower who's in temporary distress and the lender who's exercising their ultimate right, there's this crucial intervention tool.
And that's what we're here to talk about.
It is. Today, we are doing a full deep dive into that tool, that financial pressure release valve that really allowed millions to stabilize during the recent crisis. We are unpacking the definition, the mechanics, and the global variations of mortgage forbearance.
Okay, let's unpack this and really get into the weeds.
Mhm.
Because understanding this mechanism is, it's essential, not just for your own personal finances, but for grasping the stability of the entire housing market.
Absolutely.
We've synthesized a stack of high-level sources here.
Yeah.
We're talking regulatory guidance, economic research, specific policy docs like the U.S. CARES Act framework,
All things that really dissect how this pause button works.
and what it costs, and maybe most importantly, what the unintended consequences might be. Our mission here is to move past the simple definition and really understand the complex financial engineering that's involved.
Exactly. And at its most basic level, forbearance is a really simple concept. The word itself, it literally means holding back.
Holding back.
In the context of a secured loan, like a mortgage, it's a special formalized agreement. It's a contractual negotiation, really.
So a deal between you and the lender.
A deal where the lender agrees to temporarily hold back their contractual and legal right to accelerate the loan or, start foreclosure proceedings.
So it's not some secret handshake. It's a real legal commitment from the lender to delay enforcing their rights, but only if the borrower meets certain conditions.
That's it.
I often hear it called a pause button, or I guess more formally, a mortgage moratorium.
A mortgage moratorium is a great alternative term for it. It really is a timeout. And it's designed to serve two functions. First, obviously, to keep the consumer in their home.
Which is the big one.
And second, to give them a defined period to resolve whatever financial difficulty they're having.
Okay, and that second point feels really key.
It's crucial. The difficulty must be temporary or short-term, if the lender even suspects the problem is permanent. Well, forbearance is rarely going to be the first or the best option on the table.
Right, so this is a bridge, not a whole new road.
A perfect way to put it.
So let's start with the trigger and the economic rationale here. The trigger seems obvious. The borrower can't meet their repayment terms.
Simple as that.
But why would a sophisticated financial entity, a lender, voluntarily give up their income and postpone, realizing their security? Doesn't their whole business model revolve around getting paid on time?
It does. And that's where we move from what might look like altruism to just hard-nosed risk management.
Okay.
Foreclosure is not a clean, easy process for a lender. I mean, think about it. You've got extensive legal fees, huge time delays, the expense of maintaining a vacant property.
And the risk that the house's value drops before they can even sell it.
Exactly. It's an expensive, lengthy, and just messy last resort for them.
So this forbearance agreement, it functions as a kind of calculated preemptive strike against that worst-case scenario.
Precisely. The core trade-off is this. The lender delays the immediate exercise of their right to foreclose on the condition that the borrower commits to a pathway, a defined plan, to catch up to the original payment schedule by a specific date.
So the lender is essentially saying, look, we'll extend you credit for these missed payments for, say, 3 or 6 months.
Because we calculate that this extension is actually cheaper for us than the immediate cost of foreclosing on you.
But doesn't that delay just encourage, moral hazard? If foreclosure is already this messy, expensive thing for the lender, why would a borrower on forbearance ever rush to repay?
And that is the risk. It absolutely is. But the protection for the lender lies in the temporary nature of the agreement.
Ah, okay.
Our source material really stresses this. Forbearance is historically granted only to customers in temporary or short-term financial difficulty.
So the lender isn't just hoping for a recovery. They're actively assessing the odds.
They're assessing the likelihood that the underlying issue is transient. A short-term job loss, a brief illness, maybe a maternity leave, something with a clear end date.
Which means if a borrower goes to their lender and says, look, I took a new job that pays 40% less. I can never afford this payment again. Forbearance is, what, basically dead on arrival.
That's the critical distinction. If the borrower's problem is structural and long-term, meaning returning to that full payment just isn't sustainable, then forbearance isn't an appropriate solution.
Because it just kicks the can down the road.
It just postpones the inevitable. In those really severe cases, the lender has to look at a deeper, more permanent mortgage modification, which is a whole different beast. Or they have to move to realize their security.
Okay, let's double back to the lender's motivation. You said helping the borrower return to good standing better positions the lender. How so?
It's all about stabilizing their security position. By refraining from immediately enforcing their rights, they can structure this formalized, documented plan, the forbearance agreement.
And that achieves, what, two things?
Two main things. First, it maximizes the chances that the borrower actually stabilizes and the loan becomes a performing financial position again.
Meaning the lender gets their money back over time, which is what they wanted in the first place.
Exactly. And second, if the borrower ultimately fails to perform even after the forbearance period is over, the lender is now in a much, much stronger, documented legal position to then proceed with foreclosure.
Ah, so it sounds less about preventing foreclosure altogether and more about optimizing the timing and the paperwork for a potential future foreclosure if things don't work out.
That's a cynical way to look at it, but it's not wrong.
The lender gets to say, look, we gave him every chance, we formalized it in this agreement, and he still couldn't perform.
Precisely. It clears the path and minimizes legal friction down the line.
So the big takeaway for you, the consumer, no matter what kind of forbearance you get, has to be this. You are not escaping your principal or your interest obligations.
Never. The clock on the mandatory payments might be paused, but that debt meter is absolutely still running. And that's what sets the stage for all the different tailored approaches we see, especially in the U.S. market.
Okay, so if the lender's core motivation is stabilization and mitigating their own risk, it makes sense that forbearance can't be a single, uniform product.
Right. It has to be flexible.
They must have a whole spectrum of options to match the spectrum of financial distress a person might be in.
That's right. And let's look at the U.S. context, because the regulatory framework there really encourages lenders to tailor these solutions. They do a detailed assessment of the individual's temporary circumstances.
So they look at how bad the hardship is and how long they expect it to last.
And then they select the tool that provides the right amount of relief while, and this is key, minimizing the increase in the outstanding debt. Or if the debt has to increase, they ensure it's for the shortest possible time.
Our sources lay out, what, 4 primary categories of forbearance that a lender might consider, ranging from a complete stop to a really complex restructuring.
That's right. Let's list them out because they really do illustrate the full range of options.
Okay, starting with the most basic one.
Number 1 is a full moratorium on payments. This is the immediate, complete pause button. Zero principal, zero interest paid for a defined term, usually something like 3 to 6 months.
The full stop.
The full stop. After that, we get into the world of reduced payments.
And this is where it gets a little more technical, right? This is where the depth of the relief is really tailored and the terminology around amortization becomes just absolutely crucial for you to understand.
It really is.
So we have 3 subcategories here, and they're all based on how that reduced payment relates to the monthly interest that's still building up.
The first is above interest only, which is termed positive amortizing.
Then you've got below interest only, which is the scary one, negative amortizing.
And then the simplest one in the middle, which is just interest only.
Okay, and then you have the more fundamental structural adjustments.
Right. These are often reserved for more severe, but still, transient issues. That would be number 3, reduced interest rate.
And finally, the most complex tool, which kind of blurs the line between forbearance and a full modification.
Number 4, the split mortgage.
Let's focus on that distinction between the first 2 reduced payment options, positive and negative amortizing, because this feels like the absolute key to understanding whether your debt is shrinking or growing while you're on one of these relief plans.
This is the financial architecture that determines your future risk. So amortization is just the process of paying down your principal balance. A normal mortgage is fully amortized.
Meaning your payment covers the interest that's accrued that month and a little bit of the principal.
Correct. You're always chipping away at the total debt.
So if you're granted a positive amortizing deal, your reduced payment is still enough to cover all the monthly interest that's built up.
And a little extra is still going towards that principal.
So your overall debt is still shrinking just, a lot slower than it was before the hardship.
Exactly. And this type of relief is heavily, heavily preferred by lenders when they think the borrower is in a longer-term difficulty, but they still think the situation is viable.
Because they want to see that capital balance continue to go down.
Right. It stabilizes their security position.
Yeah.
It's a signal that the borrower is still actively investing in their home equity, even if their cash flow is a little tight.
Okay. Now for the high-risk option, negative amortizing. If positive amortization means the debt shrinks, negative amortization has to mean the debt is growing.
It is. Your debt is actively growing.
And the sources warn this is only for short-term fixes. Why is it so dangerous?
It is extremely dangerous if you let it go on for too long. A negative amortizing relief plan means the reduced payment the borrower is making is less than the amount of interest that accrues on the total loan balance that month.
So the unpaid interest doesn't just disappear.
Oh, no. It's immediately capitalized. It's added right back onto the principal loan balance.
Yeah, let's try to visualize that for you listening. Let's say I have a $300,000 mortgage at a 5% rate. So the interest that builds up is about, what, $1,250 a month?
That's about right.
And the lender agrees to a negative amortizing payment of only, say, $500.
Okay, so you've paid $500 toward the $1,250 in interest that you owe.
Right.
The remaining $750 is not paid to the lender. So the lender takes that $750 and adds it right back onto your $300,000 principal. Your new loan balance is now $300,750.
Oh, wow. Okay, so I paid the bank $500, but I still owe them $750 more than I did last month.
That's it.
I am effectively borrowing that unpaid interest from the lender, capitalizing it into my loan, and now I'm paying interest on that new higher balance next month.
That is the core danger. It is literally additional borrowing by you, the borrower, but it's structured as a failure to pay the full interest on time.
And if this kind of deal or a full moratorium, which I guess has a similar effect, goes on for a long time, say a year or more,
the debt can just swell rapidly. It can create a severe issue where you're underwater on your loan, making a sustainable return to performing status almost impossible. That's why these tools are only appropriate for very short-term, acute hardship cases.
So the type of forbearance you get is a direct indicator of how the lender sees your financial health. Short-term, acute problem gets the risky, rapid fix, like a full moratorium or negative amortizing.
But if it's a longer-term difficulty, they're going to require a lower-risk approach that keeps that debt shrinking, like a positive amortizing plan or a full modification.
It's a tool chosen to align the relief with the probability of your recovery.
Exactly.
You really can't discuss modern forbearance without talking about the event that turned it from this, kind of obscure financial tool into a household term.
The COVID-19 pandemic.
The scale of job loss, the economic uncertainty, it meant that all the traditional forbearance protocols were just not enough.
They were inadequate, and that led to the application of the CARES Act for government-sponsored mortgages in the U.S.
The pandemic provided the largest, most disruptive external catalyst for financial distress in generations.
It really did. And in the U.S., for loans that were backed by GSEs, that's government-sponsored agencies like Fannie Mae and Freddie Mac, the CARES Act effectively mandated forbearance options for any borrower impacted by COVID-19.
And let's define GSEs quickly for you listening. These agencies don't lend money directly to people. They buy mortgages from lenders, which provides liquidity, cash, to the market.
Right. So if your mortgage was owned or backed by Fannie or Freddie, you fell under the scope of this massive federal mandate,
which created this monumental and often misunderstood case study.
And the biggest single misconception the sources highlight, and which we just have to repeat clearly, is that forbearance is not forgiveness.
I think we need to linger on that for a second. Why did so many people think it was forgiveness? And what does it practically mean that the interest keeps accruing?
Well, it was an issue of messaging and, frankly, hope. When the government comes out and says, you don't have to pay your mortgage for 6 months, what a lot of people hear is that mortgage payment is gone.
Wiped away.
But legally, the mortgage contract is still active. If you had a $1,500 monthly payment and you took a 6-month moratorium, you simply incurred $9,000 in deferred debt.
Plus interest.
Plus interest. The interest continues to accrue throughout those 6 months, calculated on your principal balance. That $9,000 is still due, and potentially more, because the unpaid interest may have been capitalized, depending on the structure.
This brings us to the really thorny issue of credit reporting. I mean, in normal times, missing 6 payments would just crater your credit score.
Absolutely. It would make future borrowing impossible for years.
So did these CARES Act agreements shield the borrower from credit bureau reporting entirely?
They did not block reporting, and this is where the nuance is so important. The GSEs provided specific guidance. They required lenders to report the mortgage status, which would reflect the fact that the loan was past due or in delinquency.
Right.
But the CARES Act also included provisions that required creditors to report the account as current if the borrower was sticking to the relief agreement.
So it was a kind of dual reporting.
Or to report it as delinquent but avoid the really harsh, immediate punitive impact that comes with a typical voluntary default.
So the missed payments were noted transparently, so the financial system could track the risk, but that immediate devastating credit score drop, that 100-point fall, was often mitigated or delayed.
Right. It was a recognition that this was a system-wide crisis, not a case of individual financial mismanagement.
It allowed the system to stay functional while offering a temporary shield to the consumer.
It did. And furthermore, the sheer scale of this crisis demanded really rigorous lender compliance and documentation just to prevent total chaos.
What specific due diligence did the policy require from lenders when someone called up and requested a COVID-19 forbearance?
They had to engage immediately and specifically. Lenders couldn't just, process a bulk application. They were required to actually contact the consumer to get the specifics of their scenario.
Not just checking a box that says COVID hardship.
Exactly. They had to perform a genuine, even if it was rapid, assessment of the consumer's financial hardship and, critically, their expected ability to repay later.
And that assessment had to be more than just a quick phone call.
Mm-hmm.
Especially if the relief was going to be structural.
Absolutely. Regulatory guidance mandated that verbal conversations had to be validated and documented, usually through email correspondence and written agreements where applicable.
So it created the necessary paper trail.
It did. If the consumer later challenged the workout plan, the lender had to be able to prove they had assessed the situation and that the borrower had agreed to the terms.
Let's talk about duration. How long was this lifeline typically offered, and how flexible was it designed to be?
The initial plans were usually short, 3 to 6 months. But recognizing how severe the pandemic was, the GSE guidance allowed owners facing continued hardship to extend that relief.
Up to how long?
The plans could be extended up to a maximum of 12 months initially, and in some cases even further later on. But that 12-month mark became the crucial benchmark for the emergency relief period.
And the lender was expected to check in before granting an extension.
Always. The expectation was that the lender would reassess the financial hardship before they granted any extension.
And what about other temporary protections? What else did the GSEs enact during this active forbearance period?
2 big protections really stood out, giving immediate relief. First, they waived late fees. That removed an immediate layer of financial penalty.
That's huge.
And second, and maybe most vital for consumer stability, they suspended foreclosure sales and evictions entirely. The initial suspension ran until at least May 17, 2020. But those moratoriums were extended multiple times, giving millions of people a period of certainty that their housing was secure for the immediate future, no matter their payment status.
Okay, so forbearance is a temporary bridge, not a permanent island. When that bridge ends, the borrower gets dropped back into reality, and that's where the stress really kicks up again.
This is the critical moment.
Let's get into Section 4. The post-forbearance workout. This is where you have to deal with all that accumulated debt.
The mechanics of the reversion are simple, but they can be brutal. On the day the agreed forbearance period expires, the loan account automatically reverts back to its original form.
Same rate, same term, same monthly payment.
But now you have the arrearage problem.
That arrears, that's a pile of missed payments and all the accrued interest. That now has to be reconciled. In a traditional pre-CARES Act situation, how is that difference typically handled? What was the immediate consequence?
Traditionally, the simplest mechanism was to just recalculate that difference over the remaining term of the loan.
So if you missed, say, $15,000 worth of payments over 6 months, the lender would just reamortize that $15,000 across your remaining 20 years of the loan.
Exactly.
Which means your new monthly payment is calculated based on the current, now higher, loan balance, the original rate, and the remaining term, which would result in a significantly higher monthly payment.
Immediately, right when you exit forbearance.
And that's the crucial consequence. The consumer is held fully responsible for paying the entire amount due, plus any interest. Forbearance bought you time, but it increased the size of the monthly check you had to write.
And if you couldn't afford the original payment, you certainly couldn't afford the new, higher one.
So recognizing this immediate payment shock and just the sheer volume of loans that were exiting forbearance, the GSEs clarified specific mandated workout options after the COVID-19 period. This was critical consumer protection.
It was a huge deal.
What are those 4 mandated workout paths?
The guidance required lenders to offer these 4 paths, which ensured the consumer had options beyond just immediate full repayment.
Okay, what's number 1?
Number 1, bringing the mortgage payments current. This is the lump sum option, simply paying the entire arrearage amount in one go.
Number 2.
Paying the loan in full. So refinancing or selling the home and paying off the entire debt.
Okay. Number 3.
A mortgage modification plan. This is the structural fix for more permanent hardships, usually involves changing the rate or extending the term.
And the 4th option?
And 4th, deferral of payments until the end of the loan. The missed payments are essentially moved to the back of the loan term.
Okay, let's talk about option 1, the lump sum. That sounds terrifying for someone who just went through 6 months of a financial crisis.
It is.
You mentioned the GSEs specifically clarified this was not required. Why is it even listed as the first option? Is it some kind of trap?
It's not a trap, but it's listed first because from the lender's perspective, it's the cleanest and fastest way to get the loan back to performing status without changing the loan structure.
But the clarification was key.
The April 2020 clarification from the GSEs was a massive victory for consumer protection. It stated explicitly that while paying the lump sum was an option to reinstate the loan, consumers are never required to choose a lump sum option to exit forbearance.
That is the pivotal piece of information right there. It means the lender can't just demand, say, $10,000 in missed payments at the end of the term and then immediately move to foreclose if you can't pay it.
They can't. The other options must be on the table.
Which is why that deferral option, number 4, became so important during the CARES Act phase.
It was probably the most used option.
So how does that deferral mechanism actually work? I skip 6 payments, and suddenly those payments are just added to the end of my 30-year term.
It's a little more sophisticated than just pushing the term out. With a deferral, the missed principal and interest payments, let's use that $15,000 figure, are packaged up as a non-interest-bearing balloon payment.
A balloon payment.
And that balloon payment becomes due at the very end of the loan term or whenever you sell the home or refinance.
I see. So the original term and the original monthly payment don't change.
Yeah.
I go right back to paying my normal $2,000 a month on month 7.
Right.
And that $15,000 just sits there as a separate interest-free lien against the property.
Precisely. It keeps your monthly payment affordable immediately, which prevents you from redefaulting, but the lender ensures that the debt must be repaid eventually, usually when the asset is liquidated. It's a crucial mechanism for stability.
Yeah, let's touch on the most complex one,
Hmm.
the split loan. This was option number 4 in our initial list of forbearance types. It's not just deferring payments. This is actually partitioning the debt itself.
Right. The split loan is usually reserved for situations where the hardship is significant enough that the borrower can no longer service the full existing principal balance, even in the long term, but they could manage a smaller balance.
So the split loan creates 2 notes, Note A and Note B.
Correct.
How are these notes structured?
So Note A is the primary reduced loan amount that you, the borrower, can demonstrably afford to pay and fully amortize over the remaining term.
And Note B.
Note B is the difference. It's the portion of the principal you can't afford to service, along with any arrearage. This Note B is literally parked.
So if I had a $400,000 loan and the lender determines I can only really afford the payment on $300,000.
Then $100,000 becomes Note B.
And what happens to that Note B? Does it just sit there forever?
It sits there, often interest-free, until the expiry date of the original loan, the maturity date. But the critical requirement is that there has to be an underlying intention and often a real plan.
A suitable repayment vehicle?
A suitable repayment vehicle, yes.
Good.
A plan for repaying that parked loan in full at that later date.
And what would qualify as a suitable repayment vehicle?
It could be the expectation of an inheritance, the projected sale of the asset when the kids go to college, or the potential for a substantial future refinance. The lender is essentially restructuring the debt to prevent an immediate default,
while still ensuring they get their full principal back when the borrower eventually exits the property.
It's the most sophisticated tool they have for accommodating a long-term reduction in affordability while keeping their security intact.
So we've established that U.S. forbearance, especially under the CARES Act, relies on this defined federal framework and some pretty strong consumer protections. That lump sum repayment never being mandatory is a huge one.
A game changer.
Now, let's broaden the lens. This idea of holding back financial enforcement exists globally. But the regulatory willingness to mandate relief, well, that seems to vary dramatically.
Oh, it does. And looking internationally is so crucial because it shows that forbearance is fundamentally a policy choice. How a country decides to approach debt relief really reveals its priority.
Is it protecting the stability of the financial institution? Or is it protecting the stability of the homeowner?
That's the core tension.
Okay, let's start with Australia. They have something called the hardship variation. How does this compare to the U.S. model of mandated options?
The Australian model is actually very similar to the US in terms of its intent and the options available, but it's rooted in consumer banking codes, not necessarily emergency government legislation like the CARES Act.
So the hardship variation is the formal way a borrower asks their lender to change the loan terms because of financial struggles.
It is.
And I understand the options are similar. They can get short-term relief, which is their forbearance equivalent, or reduced payments over the life of the loan, which is more like a modification.
Precisely. But the key insight in the Australian system, I think, lies in its consumer protection against an arbitrary refusal.
How so?
Australian lenders are required to provide a specific reason in writing if they turn down an application for a hardship variation.
They can't just say no.
They cannot offer a blanket no without substantiating that decision.
Wow, that transparency is a pretty significant institutional safeguard.
It is. And furthermore, borrowers are actively encouraged to file internal complaints, to file disputes, and if necessary, to take the matter to an external dispute resolution scheme.
So there's a real recourse mechanism.
A very robust one. It means the burden of proof is high for the lender, which compels them to offer reasonable relief whenever they can. Australia leans heavily toward mandatory relief and transparency. They recognize the societal value of housing stability.
Okay, now let's pivot to the stark, almost polar opposite end of that spectrum, which is exemplified by Spain. What's the institutional environment like there?
Spain offers a really dramatic contrast. The attitude of the central institution, the Bank of Spain, has historically been to actively discourage banks from keeping mortgages in arrears.
Why?
This stance is rooted in the harsh memory of the 2008 financial crisis, where a rapid housing market destabilization forced Spanish banks to prioritize the cleanliness of their balance sheets above all else.
And what's the practical consequence of that institutional discouragement for a struggling borrower in Spain?
The result is a system where homeowner protection is minimized. Banks in Spain are not required to offer any relief to borrowers.
Wait, say that again? They're not required to offer any relief.
None.
So a Spanish borrower has no inherent right to even request a pause or a modification. They're entirely at the mercy of the bank's willingness to help.
That is the reality that's reflected in the source material. The banks retain the right to repossess properties and proceed with foreclosure without agreeing to any changes in the loan terms that might help a customer stabilize.
So if you miss payments, the bank can just move and move quickly.
They can move rapidly to realize their security. This system prioritizes the rapid cleansing of non-performing assets from bank balance sheets, even if that leads to increased homelessness and social stress.
That demonstrates such a profound policy difference. The U.S. and Australia prioritize temporary homeowner stabilization through mandated structural relief.
Whereas Spain prioritizes rapid financial institution stability, pushing the risk directly onto the homeowner immediately.
It just highlights that forbearance really is a choice.
It is. And if a full moratorium or a structural fix is too high a bar for some global lenders, there's a common middle ground internationally.
All right, you mentioned that many nations use temporary interest-only payments.
That is the most common global compromise. And it's because it hits the sweet spot for the lender.
How so?
The bank continues to realize its expected interest yield, which keeps its revenue stream intact, and it minimizes the amount of accrued debt that gets capitalized.
And for the borrower?
The borrower gets a massive reduction in their monthly payment because they've paused the principal repayment component. It's a mechanism that stabilizes the borrower's immediate cash flow while satisfying the lender's interest obligations. And it avoids the dangerous debt accrual of a negative amortizing deal.
So we've taken a really fascinating and pretty complex journey through the world of mortgage forbearance.
We really have.
We started with that simple definition of a holding back tool, something used only for temporary difficulty.
And we contrasted that with the high-stakes risk of negative amortization, that situation where your debt is actively growing even while you're on a relief plan.
And we use the CARES Act as the ultimate case study, defining the institutional players, the GSEs, and clarifying that crucial fact. Forbearance is a debt delay. It is not debt forgiveness.
And we saw that pivotal consumer protection, that you, the borrower, are never required to choose that lump sum option to resolve your arrearage.
And finally, that global comparison. It just starkly contrasted systems of mandated consumer relief like the U.S. and Australia.
With the more punitive, hands-off approach that's permitted in places like Spain, where institutional stability really trumps homeowner stability.
So what does this all mean for the financial landscape?
Well, I think it reinforces the core message that forbearance is a temporary financial lifeline. It's a tool that buys you time, but it never, ever absolves the debt.
It just determines when and how that obligation will be satisfied.
Usually resulting in higher payments down the line or a big balloon payment in the future. It's a tool for stabilization, not for elimination.
Which leaves us with a final provocative thought, one that kind of ties together this whole global risk calculus. If a forbearance is not forgiveness, and the interest continues to accrue, resulting in this massive deferred pile of debt, that note B, that deferred balloon payment, what does that tell us about the ultimate risk that the lender assumes when they agree to just push the problem into the future?
And how might that unaddressed, accrued, and deferred debt manifest in global mortgage markets where relief is mandated, like here, compared to a market like Spain where relief is not mandated, which forces the stress into an immediate foreclosure?
So the choice between forbearance and immediate default.
It's essentially a choice between recognizing a systemic risk right now or guaranteeing a much larger, potentially destabilizing financial reckoning that's just deferred until the entire loan portfolio matures. It's a tension between present stability and future consequence.
And that tension continues to shape global housing policy today.